Good evening, everyone. My name is Vince Tropiano. I'm a corporate international tax partner with Grant Thornton here in the Sydney office. Welcome to our first blush of this year's federal budget. With me tonight is Sandy Boswell, National Managing Partner of Tax for Grant Thornton. And online, fresh from the luck up, is Emma Maguire, Tax Technical Manager here at Grant Thornton. Welcome to both of you.
Thanks, Vince.
Thank you.
Emma, I might throw to you first to give us a summary of the highlights as you've just stepped out of lockup and let us know what's been happening.
Thanks, Vince. Yes, I'm joining you from Canberra, fresh out of budget lockup, whereby a few of us from the business world are locked up and given access to the details of the federal budget several hours before Chalmers commences his speech. It's essentially designed to ensure all players are given equal access to the information at the same time, but there are tight security arrangements, meaning we have no mobile phones and no communication to the outside world for several hours. But it's a really great time to get stuck into the budget papers without any other distractions and even have a chat with some fellow professionals about it. What we're seeing tonight in a theme, it's centred around considered measures and spending restraints, with a focus on modest but meaningful revenue measures. It is no surprise that Labor is balancing a fiscal tightrope this year, with the dialogue of late centred around skyrocketing inflation and cost of living issues. This puts Labor's election promise of boosting wages at odds with the inflationary pressures that continue to send living standards backwards. Despite this, Chalmers has reassured us that the targeted relief measures announced will not fuel inflation, but even contribute to its decline. What Labor is promising is a targeted cost of living relief package to the tune of $14.6 billion, which comes off the back of higher than expected employment, wages growth, commodity prices, and company taxes. With historic low unemployment rates, working Australians continue to be the backbone of federal government revenue, now contributing to over half of tax revenue collected. Just to briefly touch on October's budget that saw Labor honour its election promise of targeted changes to multinationals, which included changes to the thin cap rules, the denial of deductions for payments relating to intangibles held in low or no tax jurisdictions, and the reporting requirements to improve tax transparency. The government has been swift in moving these along, all reaching the exposure draft and consultation stages. We have seen another mention of multinationals tonight, with the government determined to implement the key aspects of OECD Pillar 2 of a 15% global minimum tax rate for large multinationals and a 15% domestic minimum tax. The global minimum tax rules would allow Australia to apply a top-up tax on residential multinational parent or subsidiary company where the group's income is taxed below 15% overseas. Notably, there was no mention of any changes to stage 3 tax cuts that were announced from the previous government, so it appears these are here to stay, to a degree offsetting the bracket creep that many workers are experiencing. Small business had a few mentions tonight, with the announcement of the Small Business Energy Incentive aimed at supporting the transition to energy efficient equipment with eligible deductions of up to $20,000. This could benefit up to 3.8 million businesses with a turnover of less than 50 million. Also announced is the $20,000 instant asset write-off for businesses with aggregated turnover of less than $10 million to apply for FY24. Disappointingly, the loss carryback measures don't appear to be given a further lifeline, which are notably standard inclusions in other tax jurisdictions such as the UK. Of course, one of the headline changes that we've been hearing a lot about in recent days are the changes to the petroleum resource rent tax, which is expected to generate upwards of $2.4 billion. This introduces a cap on the use of deductions to offset assessable PRRT income, bringing forward the receipts. The cap limit will limit deductible expenditure to the value of 90% of each PRRT accessible receipts in respect of each project. The changes announced are not as aggressive as initially rumoured. However, there has already been some pushback from industry bodies, which claim that the previous regime was working as intended and that this change in breaking the usual regulatory certainty will reduce Australia's competitive advantage in natural resources. Superannuation also had some mentions, with the reduction in the tax concessions available on earnings where the balance exceeds $3 million. As we've previously heard in the media, this will impact about 80,000 individuals, or 0.5% of those with super accounts. Current contribution rules will remain the same and will not limit the maximum amounts allowed to be held in superannuation accounts. Another change set to take place is the compulsory increased payment frequency of superannuation guarantee entitlements for employees to align with the payment frequency of salaries and wages. This is set to take place from 1 July 2026 and aims to ensure greater visibility over payments for employees and result in better retirement outcomes in the long term. So I'll hand back to you, Vince and Sandy, to get your take on what you've seen tonight.
Thanks, Em. Thanks for braving the Canberra weather and giving us the snapshot live from Parliament House. Sandy, Emma raised an interesting point that the government had a bit of a balancing act here with inflation, interest rates, and trying to get a budget through those, difficult parameters. How do you think they've gone? What are your first impressions?
Well, look, we've had a pretty short time frame to have a look at the budget papers, but obviously we've been watching it really closely in the press. And we had a focus here at Grant Thornton about renew and restore. So we thought that would be the thematic, and certainly we've seen that tonight from the government. It's the first time that the budget's going to be back in the black in 15 years, and I think that's to be commended. But they've got that whole balancing act, which is a really fine one, of the cost of living relief, but to contain inflation. So important, because it's really hitting everybody, both at the personal and at the business level, corporate level. So that cost of living's been a real focus in the budget papers. Also, the resilience to international shocks. So we can see that they're taking some learnings from the pandemic. They want to really try and protect our supply chains here in Australia, have some sovereign capabilities, and that real focus on renewable energy. So there's a lot of commentary throughout all of the papers on that. How are they going to do this? So some of the key flagship things, and Em, thank you, you've gone through a lot of it, and I know you've spent several hours down there. But some of the things that we've read about this evening is a $14 billion package at the personal level of savings around electricity bill relief. That's going to be $3 billion. This is at the taxpayer level. Cheaper childcare, cheaper drugs and pharmacy. We've seen that already roll out in the press. More pay for aged care workers. So they're going to get a 15% pay increase. Build to rent, so project support in that space. Housing affordability. How are they going to fund all of these things? And that's a question as you go through and hear the Treasurer speak this evening. And Emma's already touched on some of this. To the oil and gas producers, they're going to have their deductions capped. That looks like that's going to raise receipts of about $2.4 billion. The super tax changes, that got a lot of press in the last few weeks or the last month or so. Putting that cap and increasing the tax rate for super funds over $3 million. And interestingly, a personal one, increasing cigarette tax by 5%. So that's going to hurt the smokers out there, which isn't great. Disappointing, there's lots of detail in there too that as you go through the papers and we unpack it, we're going to find things that where savings are being made. One of those things that I just saw quite quickly was the tax offset for most 10 million Aussies, which is that $1,500 tax offset that's going to be cut. So there's some things in there that's a little bit disappointing for the taxpayer as well. I do like the idea of the super payday, so being paid super every payday. That's a really good outcome for working Australians. But again, that's not going to be implemented until 2026. And I'm sort of struggling to see why we can't do that earlier. Before I sort of go on to any others, but there was a couple of other key announcements that I'm keen to sort of chat through, which is the Net Zero Authority, so creating a workforce for the future. We all know that we've had a big reliance on the coal and fossil fuel industry, and I think the government's recognised that we need to We need to set up our workforce for the future. We know AI is here. We've all seen ChatGPT being launched in November and now become a everyday vernacular term that we didn't even know existed 12 months ago. So jobs in the renewable energy sector, jobs in AI, jobs in digital. So the Net Zero Authority, which Chris Bowen announced yesterday and was in the papers today, is a really important initiative around our future economy. Defence, they're putting some money in defence, no surprise, but I won't analyse that here. And there's a lot of things on industry growth, etc. So I could probably talk all night, Vince, to be honest. But there's a lot of detail in those tax changes that Emma also announced. But going back to you.
Yeah, thanks, Sandy. Emma, I might just throw back to you. Sandy just mentioned tax changes then. I know there's some commentary around multinational tax and the phrases Pillar 1 and Pillar 2. Was there anything new announced tonight, or was it just simply, a restatement of some of the announcements over the last probably 6 to 12 months?
It's really just looking like a restatement at the moment. We've seen this around for years now, and I think the government, they're really struggling to get a start date for this, and they keep bringing it up in the budget. So they're certainly determined to get it going. So hopefully this will be it.
Thanks for that, Em. I think there's a couple of things I just wanted to add to what both Emma and Sandy have spoken about. The instant asset write-off for small business with a $10 million cap, that's a reduction from what was $50 million. Probably disappointingly, I would have preferred to see that extended and extended to a wider group. I know that was one of the COVID measures, but going back historically through tax law over the last 15, 20 years, there's always been some different version of that here in Australia to encourage investment and to encourage Australian business. So that's certainly one that I was disappointed to see. While happy that it's been maintained because it was meant to be removed at 30 June 23, it's a shame that it wasn't extended to a wider group. Likewise, Emma, you mentioned the loss carryback rules. Again, that was brought in as a COVID measure, but it's not an uncommon provision in other jurisdictions and it works well there. And if you look back at Australian tax history, it was actually introduced 10 years ago and it was in place for a year or two. So this wasn't simply just a COVID thing. It would have been great to have something like that continue. So in terms of trying to support Australian business with some strong tax incentives, they were two that stood out. The cost of living package, and Sandy, you mentioned it, and I think the Treasurer mentioned that it's going to help business and help curb inflation. I know there's been a fair bit of discussion today that from a number of economists that in fact those savings will then just go to the individuals and they will just spend it. So there's a potential that's actually going to add to inflation in the short to medium term, which is interesting. So it will support those that are doing it tough through inflation and interest rates, but that might actually feed back into inflation. So it'll be interesting to see what happens with that moving forward. Sandy, I want you to put your innovation hat on. There were a number of announcements there in terms of supporting innovation, and in the past the government has been putting money towards innovation to grow sovereign capabilities. We identified during, I guess, COVID, the lack of local activity, local manufacture, where we couldn't get things into Australia. We were really struggling. So the government's been throwing money in certain areas. Do you think they're doing enough there?
Thanks, Vince. Look, we always welcome investment in innovation in every budget, and this is really part of the renew aspect of the budget. We need to invest in innovation to stay relevant in the global economy. There's no doubt about that. The world economy is moving at such a rapid pace. It's super rapid. I've, written in my notes. I don't think we can even get our own heads around it. So we know that we've got to invest in innovation in Australia at a minimum to keep pace with that change. So it's a key plank for us to make sure that we stay relevant and that we can keep up our growth and productivity and create jobs here in Australia. I was really pleased to see in the free trade agreement this week with the UK, which just got passed by the UK Parliament this week, that a key platform within that was innovation and sharing innovative ideas, sharing innovation governance. Now, how that unfolds, I'll be interested to see, but clearly it's a factor that the government's really focused on. So there's two really main elements: indirect funding of R&D, which is via the R&D tax incentive, and interestingly tonight it's not mentioned in the budget, which gives business a lot of certainty around accessing that program. It's critical, particularly for SMEs, and here at Grant Thornton, we work a lot in this growth space where the R&D tax incentive unlocks really vital cash for them to keep going on an annual basis when they're undertaking R&D that meets the criteria. But besides that, it's also direct funding. So there were some key projects and programs announced, and that's also really important. They allow fast tracking of ideas. So I think a couple of things that got announced tonight was an industry growth program of $392 million. So it will be to establish an industry growth program to support SMEs to commercialise their ideas. So I'm looking forward to hearing more detail about that. There'll also be some more injection into infrastructure priorities, so $1.8 billion over 10 years. And we saw that within that, they're talking about innovative transport projects, for example. We saw $2 billion being announced tonight for a hydrogen Head Start program. Again, looking forward to seeing the details of what those programs are. But just before I get to that and before I sort of, innovation is so critical, but I want to go back to our issue around funding these changes and funding this cost of living package that they've announced tonight. How are they going to do that? And for me, there's a couple of small print things that are worth mentioning tonight for those that are watching, which is around extension of compliance programs. And what that means in layperson speak is, I suppose, more audits and more reviews of taxpayers, both at the personal and at the corporate level. So, for example, the GST compliance program has just been announced tonight, a 4-year extension of that program. So they're going to put $588 million into that program. And they expect that to increase receipts by $7.6 billion over the next 4 years. They're big numbers. And then there's the personal income tax compliance program, where the ATO has said that they're going to have a combination of proactive, preventative and corrective activities. And they see that will raise over the next 5 years nearly $475 million. So I think it's important the government is looking to make savings. Unfortunately, to a small but really vital program, they've announced some cutbacks to that, which is the Export Market Development Program of $61 million. Sadly, for innovation too, circling back to that, they've announced that they won't implement the Patent Box program, which we were hopeful for, particularly for our life sciences sector and those that are doing a lot of patent activity in Australia. So there's some real positives and there's I think some devil in the detail there.
And again, that patent box is similar to the loss carryback. It's something which is quite common in a number of other jurisdictions.
Exactly.
So the removal of that is, I guess, maybe baffling is too strong a word, but disappointing.
Yeah, I think we could have made some inroads there if we'd have kept that.
It's coming on to about 8:33, so we're not going to take up any more of your time. Sandy talked there about looking more into the detail, which is something which we're going to do certainly over the next 24 hours and at Grant Thornton over the next month or two with newsletters and various other sessions. Please join us tomorrow for 2 sessions. There will be a wider business briefing with Paul Gourley, a financial advisory partner from Grant Thornton, with Besadida, St George Chief Economist, and it'll be hosted by Karina Carvalho, ABC News reporter. And that'll be followed by a tax-specific breakout session with both myself and Marat Chahanga and Anika Reside, both tax partners here at Grant Thornton, where we'll take a bit of a deeper dive into some of the tax measures. So we hope to see you with both of those sessions tomorrow. Thank you to Sandy. Thank you to Emma. Look forward to seeing you back in Sydney. Thank you, everyone, and I hope to talk to you tomorrow.
Good night, everyone.